So in the long term, interest rates are set by supply and demand. As interest rate is a market movement. Bank individually cannot decide on interest rate. So as we know, so interest rates are not controlled significantly by a bank alone. It's an overall market situation. Banks benefit by paying depositors a low interest rate and being able to charge borrowers a high interest rate. So this basics. Okay, but you must understand that banks cannot overprice their lending rates. So please understand this, because it is a market in which we are operating. It is a competitive market. So banks today cannot say that for a home loan I will charge 12%. Nobody will take these loans from us. So banks have to be competitive also in the market. That is the key. So we have to be reasonably profitable, and we also have to be reasonably able to fulfill the requirements of the customer, because any customers or any market will require low interest rates. Then only the demand for credit will go up. Demand for credit will go up only if the interest rates are lower. So just because you feel that banks can increase the interest rates, if you keep on increasing the interest rates, the demand for credit, the demand for loans will go down. So that is the key, right? When rates are high, loan demand tends to fall as loans are more expensive. So this is basic. Just now, as I said, when the rates are high, when the interest rates are high, the demand for loans will go down. So it is essential to have a balance where the cost of deposit is covered by the cost, and also the profitability objective of the banks are met through our lending. So that kind of management is very critical, right? So if this kind of rates, if the rates are on an increasing cycle, depositors may shift their investments from banks to other forms of investments like equities, other bonds which are giving higher interest rates. So banks will lose funds. So interest rate movement in the market has to be thoroughly understood, and banks will have to position themselves according to the interest movement of the banks of the market, right? Most Indian banks, as you see, look at where the funds are coming. The funds are coming mainly from households. So 63% of funds are coming from households for the Indian banking sector. But the advantage here is, as I said, households are savings funds. Savings funds are very, very sticky. So these are terms that you will hear more and more once you join banks, right? The savings account funds are very sticky. In the sense, people will not suddenly move all the savings and do something. They won't do it. Everybody will have a limit till which they will use their funds. Nobody will use their entire savings just like that. So these funds are very sticky, and unlike the current account funds. So if you look at the composition of funds in a bank, 63% is household funds. Corporates bring in 22%, government funds are 9%, and non-resident funds are 6%. So basically, as a banker, as you enter into the banking industry, these are all the segments that you will have to focus on. Household, which means you will have to bring in more savings accounts. Corporates, which means you will have to target corporates, meet more corporates, companies, bring in their current accounts. Government accounts, there are several government project accounts, there are several government initiatives, funds which are available. For every utilization, banks need government departments, they need to open accounts. So you will have to tap government funds. Non-resident accounts, non-residents, people who live abroad, their accounts you will have to open, NRE accounts, NRO accounts, which we will cover when we come to the NRO part, to the NR part. But please understand this, as a banker, you will have to focus on these major segments when you are working on liabilities. You will have to bring funds from all of these major segments, right? So there is a lag also between lending rates and deposit rates. See, for example, recently some 1 or 2 years back, the repo rates, when the interest rates are high, banks will immediately reprice their loans. Okay. See, please understand there is a time difference between the change in the deposit rate to the change in the lending rate. Okay. Now, when the interest rates are hiked, which means the repo rate, if it is increasing, the banks will immediately reprice their lending rates because the lending terms and conditions itself will say that basis interest movements, the banks can reprice it. So the movement of lending rates is much faster, whereas deposit rates, banks will not raise it immediately. It will take time. So this lag also adds to the profitability of every bank, right? So ICICI Bank's net interest margin rose from 4% to 4.7% in 2022. Kotak Mahindra's bank's NIM jumped from 4.9 to 5.5. State Bank of India net interest margin is 3.2 to 3.7. So you look at it, different banks between June, September, and December 2022. The net interest, because in 2022 the interest rates started moving up significantly. Repo rates were increased. So from 4, for example, HDFC from 4, 4.1, 4.2. ICICI Bank 4, 4.3, 4.7. See, so which means ICICI repriced their lending rates much faster, whereas the deposit rates they didn't increase. So your margin actually went up, right? Look at State Bank 3.2, 3.4, 3.7. Kotak Mahindra Bank 4.9, 5.2, 5.5. That's a 0.6% increase in the net interest margins, right? 3.7 Axis, 3.7, 4.1, 4.3. So that is again 0.6%. That's huge. 0.6% of margin increase is huge in terms of the volumes of business that the banks are doing. So please note how this margin goes up is because deposit rate and the lending rate do not increase at the same time. Lending rates are increased much earlier than the deposit rates. So the bank's interest margin goes up significantly. This you must understand.
Enroll today for the Banking Associate Program from Hebron Learning Hub. 2-month job-oriented course. Offline, online, weekend batches available. Convenient batch timings in the morning, afternoon, or evening. Fees of just 9,999 rupees. Placement support provided.